the LIRPs, there is no max on how much you can put in. Like if let's say,
so there is the max is relative to the death benefit. So people with high incomes can get a lot of death benefit.
Yeah.
But that's where the max falls in.
Yeah,
okay.
yeah.
And this is not something that you should do with all your money. No,
no, for sure.
It's just another way of putting money aside in a very tax favor basis.
Yeah, I mean that's with anything. Like you shouldn't put all your eggs in one basket with anything. So this is just a great play to diversify. This is we can do so many different options with this because you have the permanent insurance, which everybody wants. Everyone wants permanent insurance, but they want to pay for term insurance. They want the price of term insurance, but this is a way that you can get the permanent insurance and at the same time save that money for retirement, pull it at any time before retirement or during retirement, tax-free, and then you still have potentially have a death benefit on top of that. This is the great tax play. Who is this? So this is definitely for high net worth people or
high income people.
High income people. Okay, so high income individuals.
And it can also be used for young enough people that have a lot of assets that want to put some assets in a protected situation.
Okay. Yeah. What is the minimum age to be able to get a LIRP?
So, well, a baby.
We could get
parents can buy it on a baby.
Okay.
And so they can, now insurance companies, a juvenile gets a juvenile type policy. Okay. Which is typically not at preferred rates.
Yeah.
Because they don't know how that kid's going to turn out.
For sure.
All right. At 18, they can get preferred.
But they're insured.
Yeah, they're insured.
So like anything happens, they're already insured.
Yeah.
For sure.
So they get juvenile rates. At 18, you can reevaluate the underwriting in the policy and get them preferred rates.
Preferred. Okay. That's great.
For universal life policy.
For the universal. If let's say you have, a baby and you want to set your child up for life, you're either wife's pregnant or your spouse is pregnant, whatever, and you want to set your kid up for life, what are we talking, like a couple $100 a month?
Whatever somebody wants. The limit is, and the baby has to be born, by the way.
For sure, yeah. So baby born today. We go and set up this
in a couple of weeks.
A couple weeks later, okay. We got all the paperwork provided.
Yeah, it takes a couple. They don't typically. I got to insure babies that are like
born
less than a couple weeks old. Okay, a couple months old. They're gonna, give them a couple months.
Yeah. Okay.
Yeah, they can set up do it. They can typically, in that case, the parents are going to own the policy with the idea of gifting the policy to them when they get older.
Yeah.
Okay. So there can be some interesting things done with gifting later on. For most folks, it's not an issue at all.
Mm-hmm.
They've set up a policy and maybe at 18 or 20, whatever the number is, they feel comfortable. They can just gift the policy to the child. Okay. Now that can have an impact on gifting if it's a huge number.
Mm-hmm.
Okay. So parents can gift away, I can't remember what it is this year, $19,000 each, I think, to anybody. Two parents can gift, $38,000 to a kid. Okay. And put in a life insurance policy, or grandparents can do it.
Yeah.
And then as time goes on, then you give it to the kids. If it's a really high net, and the limit though is you can't buy more insurance on the kid than you can on the parents.
The parents, yeah. So like if I have $2 million, my child couldn't have more than $2 million.
Correct.
Yeah.
There may be a limit there too, but that all depends on the wealth of the family and so forth.
Lots of factors, sure. I mean, this is an incredible play this is a good one for grandparents that want to set their grandkids up or set their great grandkids up. I mean, my great grandma back in the day bought bonds for all the grandkids, all the great grandkids. When I was probably 18, I had like $1,200 in bonds. It was super cool.
Yeah.
She was a widow and everything, but it was cool that she did that for all of us. And something like this would be this would be like the best present that because let's say, you gift this to the child or the kid when they turn 18, they could take some money out for college if they need it, or 20 or whatever, they could buy their first house, take out some money for the down payment. They still have, some savings and some life insurance. It's an incredible opportunity. And if they just want to let it ride, they don't need the money, just keep it till retirement. You can retire when you're 40,
That's right.
So
it works great. So just have to keep in mind that it does have to be managed.
Mm-hmm.
And
what does the management look like? Because that's maybe a question.
Okay,
for some
so
people.
keep an eye on the cash value. How are the accounts performing? Just like you do in any kind of brokerage
just
account.
like anything. Yeah, every year at least a couple of times a year, you want to take a look at your stuff and see what it's doing.
Yeah.
Yeah.
And, speak to your agent, your advisor, or direct with the insurance company as well, because they have people, customer service people that can advise you. Not advise you, but they'll tell you the facts.
Yeah, they'll tell you things. Yeah, good. Okay, so we already talked about why this makes a lot of sense for the tax benefits. We talked a little bit about who it's for with the high income earners. When would be a good time for anybody to set this up?
Okay, so you want to set them up before age 55.
Age 55. That's kind of like where it doesn't
because
make sense after.
Yeah, it does. It's not as effective because it requires time to make it work.
Yeah, just like the growth of any money.
Yeah.
You wanted to sit there and, rule of 72.
The truth is you need about 15 years to make these work.
Okay.
And at that point, then they're pretty golden.
Yeah.
Okay.
And then as far as payments are concerned, like, could you set this up as like we talked about 7-pay or a 10-pay or 15-pay, or could you pay indefinitely, or what the pays on that?
So personally, I think 7-pay is kind of the sweet spot.
Okay.
But you can pay as long as you want because it keeps working just fine. But 7 is enough to make it work. And it also gives people, emotionally a limit. I don't do this for forever. I can do it for a period of time.
I'm going to do this for 10 years only and I'm done with it.
Then reevaluate at that point.
Yeah, maybe you're making more, maybe you're retired, who knows then as far as like, let's say I set it up as a 10-pay and I'm paying, let's just say $1,000 a month. What if I have a really good year? Could I add some? Or
so that's the one thing that's not great. Okay.
Yeah.
Because we're funding it up to, but not above, what's called the Modified Endowment Contract limit.
Okay.
Which is federal guidelines that allow a certain amount of death benefit relative to the premium.
Okay.
If you go above that, it changes the tax nature of it.
Okay.
So we're already going to fund it to the limit.
Max.
Okay. We're very close to it.
Yeah.
Okay? So it doesn't really allow much wiggle room for putting more into it.
Okay.
You can always reduce it.
Yeah, let's say I have a bad year and like, we got to cut, our business didn't do good. We got to let go of some people. And this is one of the things I need to pull back on. Instead of paying $1,000 a month, could I go down to 100 or
Yeah, of course
nothing?
You can. So any kind of index universal life, variable life, or just plain universal life, huge flexibility in premium payments. Okay.
Yeah. And obviously those numbers at the end are going to be different as you adjust that, but yeah, that's good. And then let's say, so essentially if right now I set up $1,000 a month, I get that LIRP set up, I set up one for everybody in my family, and then I have a really, really good year 2 or 3 years down the road, or, I sell a business and I make this profit and I want to put that somewhere besides all the other places I'm putting it. Could I do an additional LIRP, or what would
you can do an additional one? You could definitely do an additional one as long as you're healthy.
Okay, so you'd have to prove reinsurability, and then
you got to increase the death benefit to
not cause a MEC or a modified endowment contract. Okay, that's good. That's great options. Let's talk really briefly and not really go into super depth, but how there's a big philosophy out there about only buying term insurance because it's dirt cheap, and using that during your working years, and at the same time save money. Hopefully you're disciplined enough, which most people aren't, to save the amount that that you save between whole life or whatever and permanent insurance and the term, and put that in an investment account, and the growth on that and the tax on that compared to this.
So term invested difference is a viable concept. Typically if you're young, the term insurance is very inexpensive. Where it runs into trouble is down the road, where maybe you got a 20-year term or whatever it might be, or a 30-year term. You come to the end of that term, you still want insurance. It's now too expensive by far, because it's way more expensive than the whole life or than anything else. And as a result, then you'll be without insurance most likely, because it'll be too expensive to get. Now, you can then buy a permanent policy, far more expensive, of course, out of pocket.
Or less death benefit.
But anyways, term in the short run is the cheapest. In the long run, it is by far the most expensive.
Almost everybody outlives it,
So 98% chance of outliving it.
98%. That's why it's so cheap, because they know it's a moneymaker.
Yeah.
So
when you talk about insurance being an expense, term insurance is a pure expense.
It's like car insurance. Like, unless you get in an accident, you're just throwing money down the toilet, unfortunately. but you have to.
Permanent insurance, you got to get some money back.
Get some money back, yeah. And at least all the money you put in is sitting right there, you know. So essentially another option, because all these are, depending on everybody's financial situation, you could set up the LIRP plus some term on top of that. So a 30-year term with a LIRP, you know, a couple of grand a month. And then we got the retirement, we got those tax benefits from that. And obviously I'm maxing out all my qualified options, my Roth, all that stuff. And I got, you know, I'm diversifying. So I have, this is kind of like the guarantee money, and everything else is obviously term is if something really went bad quick and in a short term, but everything else is just kind of giving me different returns. So yeah, that's a good strategy. That's really good.
So yeah, we do that all the time. That's, you know, do a combination of things, knowing that the term insurance is probably not going to pay out.
For sure.
Okay. And
Yeah.
you do it for a period of time, knowing it's going to go away. Okay.
Yeah. And then one of the things I like about the LIRP is that most people, honestly, like just being super honest, they're not disciplined enough to invest the difference. They'll pay the term, but then they don't invest the difference. And then when they get to retirement, like, oh no, you know, I'm glad I saved the money, but I mean, I saved the money on the term expense, but now I don't have insurance and I don't have the savings.
Right.
So
That's what happens
the LIRP,
all the time.
yeah, it's super common. And the LIRP forces you to have what a perceived monthly payment. Like this is just like me paying a car note every month, you know, $500, $1,000, whatever. So, and I'm only going to do this for 10 years and then I'm done with this note.
Yeah.
So
what we compete with is all the other things people want to buy, right?
for sure.
The real competition. Okay. That they want a nicer car than they really should
Yeah,
be
yeah.
buying.
Unnecessary.
Yeah. You know, those are things we don't want to get too preachy about that, but
For sure. Yeah, it could be necessary for somebody if that's what you like. Yeah.
you know, if you're really smart, if you're wise, you'll do some money, put it aside or something like this.
Yeah.
It's a wisdom move.
Yeah.
You know.
Yeah. This is guaranteed, you know, guaranteed.
Well, I don't like to use the word guarantee because honestly, what's really guaranteed?
Yeah.
But it's pretty sure. It's safe.
I mean, life insurance is pretty.
Well, there are guarantees, but those are, I don't want it too philosophical, but anyways, I'm not a big believer in when people say it's guaranteed.
Guaranteed. Yeah. Okay. That's good.
Everything can fail.
Everything could fail. Yeah.
That's important to keep in mind. Everything can fail. Okay. So, you know, do something that's fairly safe. Okay. That's pretty safe. Get yourself some safe money.
Super safe money.
Yeah.
I like that. And yeah, again, we have a lot of different ways we can set these up. We can set these up for children, for newborn babies. We can set these up for, you know, anybody. Essentially, it works for, like Kurt said, anybody under age of 55. It's going to make some sense depending on your financial situation, depending on your current allocations, depending on your income. There's a lot of factors. Can these be set up for foreign nationals?
Absolutely.
Okay. Does it make sense for our friends in the, you know, Latin America, Caribbean,
Absolutely.
Europe,
They
Asia?
do lots of that. That's, you know, most U.S.-based life insurance policies that are provided to foreign nationals are accumulation type products.
Accumulation products, yeah. That makes a lot of sense. You live in a country where, you know, there's currency devaluation or instability with the currency. This guarantees you dollar payout.
Yeah. It's like a treasury account. Okay. So in other words, everybody's got their safe money, right? Why not use this for safe money?
Yeah.
It's a better return than regular treasuries, and it's safe money that you can access anytime you want.
And as far as tax benefits for our friends that are global citizens,
So it depends on the jurisdiction.
Jurisdictions, okay, yeah, okay.
But U.S.-based life insurance, normally it grows tax deferred.
Okay.
Okay.
Awesome stuff. All right, anything else you can think of with the LIRPs?
And we could talk about this all day long. We're getting really deep details, but it's something that I personally have used in the past that it actually helped me put my kids through school.
Nice.
You know, and as opposed to using qualified money, I was able to access some of my cash value. And so it's been a benefit to our lives, and I found it to be very useful. And people in businesses that have high risk of creditors, such as people in the medical profession and so forth, this is a fantastic way, because the other benefit to life insurance is that in most states, it is a protected asset. For example, here in the state of Florida, it's protected as your own personal home. The cash death benefits, the distributions with death benefit protected, the cash value is protected, the distribution of the cash value protected.
So as a physician, or let's say you get sued, or your practice or whatever, your business gets sued, this is not an asset that could be gone after.
Correct.
That's huge. Yeah. As opposed to investment accounts.
Investment accounts, which are totally,
So there they get you, man. Yeah. That dream of getting 15-20%.
well, your qualified accounts are protected.
Qualified or protected, yeah.
Okay. Annuities are protected. And life insurance
Life
is
insurance.
protected.
Okay. But the brokerage account.
Brokerage accounts
Yeah,
are
yeah.
not.
So they're
Or bank accounts. They're not
yeah,
protected.
yeah, for sure. Good stuff.
Or your boat, or your second home, or your,
All those vehicles. Man, that's awesome. This is an incredible play to set your kids up, set your grandkids, your great grandkids up. This is an incredible play to diversify your income sources, to diversify your investment, add some life insurance that's permanent. That's something that everybody should have, and then tax benefits are incredible. So awesome. This is a huge benefit for a lot of people. Great play. Yeah. So that's good stuff. Do you have anything else you can think of, or is that?
that's good for now.
Yeah, perfect. Awesome. Thanks again for hanging out with us today. Hope you learned something about the LIRPs, the
Life insurance retirement plans.
life insurance retirement plans. They are a great option. Lots of really good stuff here. If you have any questions about the LIRP, either drop us a comment in the comments below, or reach out to us directly, and we can talk about that. We can see if that's an option for you or anybody in your family. And this is a great plan for a lot of people. So good stuff. We hope to see you on the next podcast, and we'll see you then.
Thank you.